Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Coke stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Coca Cola generates more than half its revenue from selling syrup concentrate to various bottlers. This means more than half of their products are not sold by the company, they're sold by the bottlers. There's bottlers all over the world and they have territories. Some bottlers control an entire country, some bottlers just control a region within the country. Although Coke does own the anchor bottler in North America, so it does generate revenue from selling some finished products. I'll show you later on their financials what I mean. The company is headquartered in Atlanta, Georgia and was founded in 1892. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, Xetra, Vienna, EuroTLX, Swiss, Sao Paulo, Buenos, Bulgaria, Santiago, and Kazakhstan. Let's get started with the model. This is a large cap company, 279 billion market cap. They're trading at $65 a share and they have 4.3 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. And they generate tons of free cash flow, 8.4 billion up to 10.2 billion. They generated the most in 2021, over 11 billion. Free cash flow is a cash that's remaining for you, the investor, so the company can pay a dividend, they can buy back stock, or they can invest back into the business to grow it. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that peaks in the trailing 12 months at 10.3 billion. Revenue is the sales for the company, and that also peaked in the trailing 12 months at over 40 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that's highest in the trailing 12 months at over 24 billion. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue, such as marketing. Gross profit minus operating expenses gives you your operating income. That was also highest in the trailing 12 months at 11.7 billion. They received $288 million on their investments. They paid 1.3 billion of interest on their debt, which is lower than 2021 and 2020, but it is higher than 2019. It looks like they usually pass through a gain on other income and expenses. These are all the gains or losses not part of the company's core operations. An example is a gain on the sale of an asset. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which also peaks in the trailing 12 months at 10.3 billion. This is their income statement from their latest 10Q. This is the first quarter of 2021 and the first quarter of 2022. Their revenue in the first quarter of 2022 is 10.5 billion, up from 9 billion. Of the 10.5 billion of revenue, 3.5 billion is in the US, 7 billion international. And you see more than half their revenue comes from the sale of concentrate. This means they sell the syrup or powder to the bottler, and the bottler actually sells it to the convenience stores or wherever. They also receive 4.8 billion from selling finished products. They have a huge bottler in North America. That's why their revenue in the US is higher in finished products. Below revenue is cost of goods sold. That's 4 billion. Their gross profit is 6.4 billion. SG&A is 3 billion. Operating income is 3.4 billion, up from 2.7 billion. They paid a lot less interest on their debt, 182 million compared to 442 million. Equity income is their investments in other companies. That was a gain of 262 million. So their net income was 2.8 billion, up from 2.2 billion. Their EPS is 64 cents. Last year was 52 cents. And they have pretty much the same shares outstanding, 4.3 billion last year and 4.3 billion this year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they generated 11.6 billion of cash flow in the trailing 12 months. It was highest in 2021 at 12.6 billion. And of course they spent a good amount on CapEx, 1.4 billion. Operating cash flow minus CapEx gives you your free cash flow. And they have lots of free cash flow, so they do pay a dividend. They also buy back stock. They bought back $500 million in the trailing 12 months, 100 million, 100 million, and 1.1 billion. But it does appear they issue more capital stock each year than they buy back. Except in 2019, they issued a little less than they bought back. They do have a pretty big amount of debt on their balance sheet, so it looks like they usually roll their debt each year. They issue a similar amount as they pay down. This is the operating section on their statement of cash flows. And the way you calculate operating cash flow, you start with your net income. That was 2.8 billion. Then you add or subtract the non-cash items on the income statement and adjust for changes in working capital. So in the first quarter, they generated less cash flow than their accounting profit. And it looks like a big reason was changes in working capital. Ideally, you would like to see a company generate more cash flow than their profit. Maybe this is more of a timing thing. Maybe in the first quarter, it looks like this, but in the second, third, and fourth quarter, their operating cash flow will be higher than their net income. I like to track a company's revenue, that's the blue line, and operating cash flow, that's the orange line. Their revenue is lower now than 2015. It looks like it was coming down for a few years, but in the past year it has increased. So that's not such a great sign, but it's still a ton of revenue, $40 billion. But they do generate a pretty healthy amount of cash flow each year because their expenses are kind of low. Because as I showed you, more than half their beverages are made by someone else. So the bottler has to do all the manufacturing. This is their investing and financing sections on their statement of cash flows. In their investing section, they purchased 835 million of investments and sold 1.3 billion. They disposed of a business and received 218 million. They invested 217 million in capex. So they had a cash inflow of 146 million in their investing section. In their financing section, they added $1 billion of debt. They paid down $1 billion of debt. They issued 449 million of stock. They bought back 546 million of stock. They paid 1.9 billion of dividends. So they had a cash outflow of 3 billion. Last year was a cash inflow of 364 million because they added a lot more debt than they paid down. This is the equity section on their 331 balance sheet. They have 25 billion of equity. They received over 20 billion from selling stock. They profited 70 billion from running their business, and they bought back 52 billion of stock. When a company buys back their own stock, they put it on the balance sheet as treasury stock. That's a contra equity account, so it brings down your equity balance. Let's look at the capital structure. 25 billion of equity, 42 billion of debt. They're 37% equity, 63% debt. Their net debt is 31 billion. Going back to 2015, they have a higher debt balance each year than their equity balance, but they do keep a ton of cash on their balance sheet. Some really big companies use debt because it's a cheap way to finance your growth. As long as you bring in enough cash flow, it's fine. The problem is if interest rates go up a lot and cash flow doesn't go up that much or even goes down, it could be a problem. I gave them the lowest whack on Finbox, 6.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 302 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $272 billion. We divide that by 4.3 billion shares. And we get a calculated stock price of $63. They're trading at $65, so they're trading at a 3% premium. It's a sell according to the model. Their revenue is projected to be $46.5 billion in 2024. In 2023, it's $44 billion. 2022, it's $42 billion. I continue the revenue growth into 2025. That's how I got $49 billion. They convert on average 26% of their revenue into free cash flow. So I multiplied their future revenue estimates by 26%. That's how I got their future free cash flows. Simply Wall Street values the company at $73. They're saying it's 11% undervalued. 19 analysts price this stock and the average price target is $70. The low is 60, the high is 76. This is where the stock has been trading the last 5 years. So it looks like it's done pretty well. It was 60 in March 2020, then it looks like it fell to around $35. But ever since that bottom, it's pretty much gone up. Maybe Warren Buffett knows what he's doing. They pay a quarterly dividend of 44 cents. That's a yield of 2.7%, 74% of their net income, 74% of their free cash flow. Their dividend yield is pretty steady the past 10 years. It's projected to be 2.9% in 2024. They've done 6 stock splits, a 2-for-1 in 77, a 3-for-1 in 86, a 2-for-1 in 90, 92, 96, and 2012. They have a beta of 0.66, so the stock is not too volatile. It moves less than the market. It's gone up 19% in the past 52 weeks, while the S&P is up 2%. The 52-week low is 52, the high is 67, and the stock is trading above its 50-day and 200-day moving average. This is a really popular stock. Over 20 million shares are traded each day. Of the 4.3 billion shares outstanding, 3.9 billion are on float, 70% are held by institutions, and 2/3 of 1% of the shares are shorted. If you invested $10,000 into this company 10 years ago, you'd have $23,000 today. That's a 9% annual return. The CEO's annual salary is $1.6 million, and their total compensation is $25 million. In the past 12 months, there's been only insider selling, no buying. That's not something you want to see. The current stock price is higher than all these sell prices. 60% of the company is held by institutions, 30% by the general public, 9% by public companies, and 0.7% by insiders. The biggest shareholder is Warren Buffett's fund, Berkshire Hathaway. They own 9.2% of the company, then Vanguard, BlackRock, State Street, and Wellington. Their employee count has gone down over the years. It looks like it was about 120,000 in 2016. Now it's 79,000. Let's look at their financial ratios. They have a PE of 27, that's stock price over earnings per share, price to sales of 7.0, and a price to book of 11.2. Their price to free cash flow is 27.3, that's stock price over free cash flow per share. Let's look at their non-current assets. 18 billion of equity investments. These are their investments in other companies. 788 million of other investments. 6.4 billion of other non-current assets. 2 billion of deferred income taxes. This should help decrease their taxes in the future. 9.8 billion of PP&E, 14 billion of trademarks, 20 billion of goodwill. Goodwill is the premium you pay when you acquire another company, and 750 million of other intangibles. Let's look at their non-current liabilities. 37 billion of long-term debt, 8.3 billion of other, and 3.1 billion of deferred income tax liabilities. This should increase their taxes in the future. They have a good ROIC of 17%. They do have a lot of debt, but they can cover the interest payments on their debt almost 9 times. A really high ROE of 42%, and a good current ratio of 1.2, that's current assets over current liabilities, and a quick ratio slightly below 1. Quick ratio is current assets minus inventory. You take that number and divide by current liabilities. Let's look at their current assets. 8.4 billion of cash, 1.9 billion of marketable securities. These are short-term, highly liquid investments like commercial paper. 4.6 billion of receivables. This is how much money their customers owe them. 3.4 billion of prepaid expenses. This is when a company makes an advance payment for a product or service they're going to receive in the future. And 3.7 billion of inventory. 2.3 billion of the inventory is raw materials and packaging. 1.2 billion is finished goods. Let's look at their current liabilities. 13.3 billion of accounts payable. This is how much money they owe their vendors. They owe 3.6 billion on loans. The current portion of the long-term debt is 1 billion. And accrued income tax is 866 million. These are taxes the company owes the government. In the trailing 12 months, they generated 10.2 billion of free cash flow. They have 3.4 billion of working capital, and they pay out 7.6 billion in dividend payments. So it looks like the company is pretty well funded. They have 6 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. There are 19 companies in the same industry as Coke. And if Coke has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They do spend more than average in CapEx. They have a worse debt to equity ratio than average. Pepsi's even worse than them. They pay a high dividend, a lot higher than average. They generate the most free cash flow. They're the largest company. They don't have that good of a price to book, but their PE is a little better than average. Their price to free cash flow and price to sales are worse than average. Look at that. Pepsi generates twice as much revenue as Coke. That's pretty amazing. And their 3-year annual growth rate is only 5%, average is 20. But they have a really good ROA and ROE. So to summarize, I have them trading at a 3% premium. But this is a great long-term hold. You really can't go wrong. You get your dividend and such a stable brand. It's probably one of the top 5 most well-known brands in the world. The only brand that's maybe more well-known is McDonald's. I rank their free cash flows 8 out of 10, their revenue 9 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.